Building a brighter future. Investing for your family's dreams. You work hard to provide for your family, and you want to secure their future and build a life filled with possibilities. Investing can help you achieve these goals. It's a powerful tool that can grow your wealth over time. Imagine funding your children's education, buying your dream home, or retiring comfortably. These dreams can become reality with smart investing. Investing doesn't have to be complicated. You don't need to be a financial expert. This guide will break down the basics of investing in simple terms. We'll explore different investment options. We'll discuss the risks and rewards involved, and we'll empower you to take control of your financial future. Remember, investing is a marathon, not a sprint. It's about making consistent contributions over time. It's about watching your money grow steadily. With patience and the right knowledge, you can create a brighter future for yourself and your loved ones. Let's start building your legacy today. Investing is a journey, and every journey begins with a single step. Are you ready to take that step towards financial freedom? Let's dive in. Understanding the building blocks, stocks, bonds, and mutual funds. Let's break down the world of investing into digestible pieces. Understanding these fundamental components is crucial for anyone looking to build a solid investment strategy. We'll explore 3 common investment types: stocks, bonds, and mutual funds. Each of these plays a distinct role in a well-rounded portfolio. Think of these as the building blocks of your investment portfolio. Just like constructing a building, a strong foundation is essential. Each block plays a unique role in helping you achieve your financial goals. By understanding how they work together, you can create a balanced and effective investment strategy. Stocks represent ownership in a company. When you invest in stocks, you become a shareholder, which means you own a part of that company. When you buy a stock, you're buying a small piece of that company. Stocks can be volatile, meaning their prices can change rapidly. Their prices can go up or down based on company performance and market conditions. This volatility can be influenced by various factors, including economic indicators, market sentiment, and global events. But they also offer the potential for high returns over the long term. Historically, stocks have outperformed other types of investments, making them an attractive option for growth. Bonds are like loans you give to governments or corporations. When you purchase a bond, you are essentially lending money to the issuer in exchange for periodic interest payments. They offer fixed interest payments over a set period. This predictability makes bonds a popular choice for conservative investors. Bonds are generally considered less risky than stocks. They provide a more stable and predictable return, which can be appealing during times of market uncertainty. They provide a steady stream of income. This can be particularly beneficial for retirees or those looking for a reliable income source. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. They offer instant diversification, which can help mitigate risk. This helps spread your risk across different investments. By not putting all your eggs in one basket, you can reduce the impact of any single investment's poor performance. Mutual funds are managed by professionals. These fund managers use their expertise to make informed investment decisions on behalf of the investors. This can be a convenient option for hands-off investors. If you prefer not to manage your investments actively, mutual funds can be an excellent choice. Now that you have a basic understanding of these building blocks, let's delve deeper into each one. We'll examine their unique characteristics and how they can fit into your overall investment strategy. We'll explore their characteristics, benefits, and risks in more detail. Understanding these aspects will help you make more informed decisions and tailor your portfolio to your specific needs and goals. This knowledge will empower you to make informed investment decisions. With a solid grasp of these investment types, you'll be better equipped to navigate the financial markets and work towards achieving your financial objectives. Decoding stocks. Owning a piece of the pie. Imagine owning a tiny piece of your favorite company. That's what it's like to own stock. You become a shareholder, participating in the company's growth and success. Stocks have the potential for high returns. This makes them attractive for long-term growth. However, stock prices can fluctuate. They are influenced by factors like company performance, industry trends, and overall market sentiment. This volatility means your investment can go up or down in value. It's essential to understand and accept this risk. Investing in stocks requires a long-term perspective. Don't panic over short-term market swings. Focus on the company's fundamentals, its products, services, leadership, and financial health. If you believe in the company's long-term prospects, ride out the market's ups and downs. Remember, diversification is key. Don't put all your eggs in one basket. Invest in stocks across different industries and sectors. This helps mitigate risk and potentially increase your chances of earning consistent returns. The steady path. Bonds in your financial security. Bonds are the reliable savers of the investment world. They offer stability and predictable income. Governments and corporations issue bonds to raise capital. When you buy a bond, you're essentially lending them money. In return, they pay you regular interest payments, known as coupon payments. Bonds typically mature within a specific time frame. At maturity, you receive your principal investment back. This makes bonds an attractive option for preserving capital and generating a steady stream of income. They act as a ballast in your portfolio, providing stability during market volatility. While generally considered less risky than stocks, bonds are not without risk. Interest rate changes can affect bond prices. Inflation can also erode the purchasing power of your bond's interest payments. Diversifying your bond holdings is crucial. Consider investing in bonds with different maturity dates, credit qualities, and issuers. This helps manage interest rate risk and potentially enhance your overall returns.